let's continue talking about developing an investment thought process. I listened to a YouTube video from New Harbor Financial this morning. I listened to it twice. I will put a link to it in the description of this video. And I think this is a really good video to listen to for a variety of reasons. One reason is the gentleman who was presenting it did a wonderful job of just presenting everything very, very neutrally. It was mainly based on the treasury market and what either like the treasury or the Fed is doing, and he pulled up a lot of charts from the St. Louis Fed, the Fred website. There's a lot of data on there, and talking about what's currently happening with treasuries and three different scenarios or outcomes that why they might be doing, XYZ event. And I loved it because it was informative, and there was, I felt, zero opinion of good or bad, right or wrong. Like, it was more of just like, well, this is what happened before, this is what's going on now, this could, or maybe it's because of this, and I think in investing and trading, I think it's really wonderful to have this framework or the ability to look at things without being emotionally charged over it, without having some sort of right or wrong type of opinion, and just like a whole neutral, like, this seems to be what's going on, this could be going on, that could be going on. As a side note, I saw two deer. Unfortunately, I couldn't get my phone out fast enough to start it. They were running away. Might be able to hear some bird. And so how do you develop that? One thing that I think could be helpful is, if you're not already actively using the risk profile tab in Thinkorswim, which is like a sub tab of the analyze tab, start using that. Get familiar with how to read a risk graph and how to use the different features in the risk profile. Because you can look at, let's say if you're considering doing selling a credit spread. I don't care whether it's you're taking in credit for selling the puts or selling the calls. Let's just say you're selling a credit spread on one side of the stock, because you believe the stock is going to go the opposite way, and so that's what you're doing. You think it's going to go up, so you decide you're going to sell this put credit spread. But when you use the risk profile, you're able to theoretically look at things like, if the stock were to take a 5, 10, you can put the number in, but let's say just a 5% correction. So instead of the stock going up, which would make your put credit spread increase in value, it's going down, which causes it to decrease in value. Generally speaking, I know there's other Greeks that we need to put in there, like theta and things like that, but just keep it kind of simple. So if it does take a 5% correction, what would that do to your position? And maybe more importantly, what would it do to the buying power required to keep the position open? Is it a good or bad thing? I don't think so. I think it's just a neutral thing. It's just this is the credit spread. This is how much buying power it takes at the current price the stock is at. If the stock were to drop 5%, this is how much buying power it would take. with all your different positions on, do you have that much buying power to withstand a 5% drop in this particular stock? What if it's a 10% drop? And then you can look at the charts to kind of gauge an idea of where support and resistance is, and how likely is it to pull back. Like, let's say you find some support line, and it's like a 10%. It would take a 10% drop, and then you can just kind of figure out, like, how much buying power would it take? Do I have that buying power? And then you can look at the market, and what's the market doing, and what's the beta of your stock. And if the beta of your stock is, let's say it's a high beta stock, like something like Palantir, and then you're factoring in what would happen if how much is Palantir going to move if the stock market took a 5% drop. Maybe Palantir might drop down by 10%. So do you have enough buying power to do that? What are you going to do if that happens? If you catch yourself saying that's not going to happen, then I think those sort of, I don't know, unbridled confidence, not sure what to call that, but that certainty of saying something is not going to happen is probably what gets people in trouble. I think there's greater wisdom in saying a stock can move three ways: up, down, or sideways. So let me look, if it moves down this amount, what buying power is going to be required of me? If it moves sideways, what buying power is going to be required of me? If it moves up, what buying power is going to be required of me? And look at these different things and plan for it. Look at where some of the worst case scenarios are, and what would you do if those worst case scenarios happen? And not only, so that's in a very like small macro thing. We're just looking at one stock and kind of the stock market. But the stock market, some people would say, is a derivative of the debt market, the treasuries, and all this type of stuff. That even though I can listen to people talk about it, and I can have some idea of what they're talking about, if people were to gauge true understanding by the ability to teach other people, then I don't have that type of understanding of the debt market. I just have a rudimentary understanding of it. I have enough understanding to learn more from people smarter than me, but not enough to really explain things to you. So I suggest watching this New Harbor Financial, wasn't an interview, presentation, and listen to the gentleman's 3 scenarios and look at what your different positions are. And if for each of these 3 scenarios that he talks about, how would that affect your positions? Or if you don't really have any positions on, what positions might you put on under each of these 3 different scenarios that he's talking about? I think the more flexibility we can have as traders and investors, and sort of a detachment from what should be, and a greater attachment to what are these different possibilities of outcomes that can happen. And under these different possibilities, what would that do to my brokerage account? And what should I do in response to one of these things happening? That sort of thinking, which from the way that I grew up is 100% different from the way that I grew up. I really had to develop this from listening to people that were way more successful at trading and investing than myself in order to develop this. But and not only myself, from the way that I grew up, but from what I see of modern, I guess, political discourse, or the modern state of society in the United States, seems to be, from my perspective, that we live in a very polarized society. I heard someone mention that they heard it from someone else, right? So this is big hearsay. But what they were saying is that that it's so extreme that we don't live in one country. We live in 2 different parties. And it's easy to allow one's ideology of what should be and what shouldn't be, and what's right and what's wrong, and all these different ideological things. It's very easy to get tied up in those things and allow those things to bleed into thinking logically about what is and what could unfold under certain scenarios. In a way, I think we could say it's kind of like a car crash. Generally speaking, no one wants to be involved in a car crash. But if you are in the process of crashing, whether you think it's a good thing or a bad thing, it's happening. And how you respond and what you do in those moments of the car crash and even afterwards, if it's based on what you want things to be, not the reality, not what it is, not what is unfolding, not the events that happen as a byproduct, a cause and effect thing. Those, if you're making decisions and you're processing information from this place of, I don't want it to be this way, I want it to be this way, then what sort of outcome do you get? Like, do you pretend that the car didn't crash? I don't know, man. I don't know. You know, and it seems so silly to say that, because hardly anyone would do that. Now you could say, well, people flee from the scene and all this stuff, and maybe that is an example of pretending you didn't want it to happen, lying or whatever else might happen. I don't know, but one thing I love about trading and investing is that you could lie to the cops, you could lie to the courts, you could lie to the person that you crashed into or they crashed into you. You can manipulate through communication. You can manipulate situations to your advantage. Even though it might not be the truth, you might get an outcome that you want based on your ability to manipulate via communication. In fact, I made a whole 15-minute video on I think it was 5 offensive reasons why people fail to become full-time traders. And it's all kind of summed up to a lot of people that manipulate situations to achieve outcomes they want via communication. Those type of people, that strategy is not successful in the stock market, whether you're trading or investing, because we as retail traders, we cannot manipulate the stock market via communication. There's no way you can do it. You cannot bully something into happening in the stock market. You can't talk complexity and make it seem like you're all smart to the stock market and confuse the stock market. And all of a sudden the stock market just gets so confused of your jibber jabber that's coming out of your mouth. And so they give up and they don't even know what's going on, and you just confuse them enough and they let you do your thing. That doesn't happen in the stock market. There's no way you can seduce your desired outcome in the stock market. So those type of behaviors, those things that we as humans do every day. Now, I know you watching this, you're the most moral person to ever walk the face of the earth. You've never manipulated a situation. You're always Mr. or Mrs. Integrity. Never once have you manipulated any situation through communication. Of course not. It's only us peasants like myself. I admit I have. So I think understanding this, and then step one is realizing, do you do this? And to be honest with yourself. You can lie to me. You can lie to other people. You can lie to yourself. But you can't do it to the stock market. That's what I love about it. The stock market exposes those people. Now, there are people that can do it. Listen to listen to some of the interviews by, what's that Mad Money guy? Jim Cramer. He talks about specifically when he was a hedge fund manager, how he'd manipulate the market. So I'm not saying it's impossible. I'm saying average people, I consider myself to be amongst the average people, even though I am not average. I realize that I'm a pretty unique person, but people that, you know, people that are not born into, like, you know, I don't know, the Walton family, Clintons, Trumps, Bidens, like these, and the Prince Saudis and all this type of stuff. Maybe those people can manipulate stuff in the markets. Maybe they can have trades unwind because they made improper decisions. But usually anyone that's watching this video and your good buddy that's making this video, we're not in that position. So we want to, number one, figure out, are we doing this? Are we the type of people that manipulate situations through communication, and we don't deal with what is, and we try to take what is and try to somehow manipulate the situation to the way we want it to be? And if you are a person that does that, then you want to start working on ways to minimize that and not be doing that, and just looking at, there's 3 ways a stock can move. There's 3 ways the market can move: up, down, and sideways. And what am I going to do if it moves up? What am I going to do if it moves down? What am I going to do if it moves sideways? You might not have to do anything. It might work to your advantage, but you won't know unless you don't look at it. And so I think that's mainly what I want to share as we continue down this conversation of how to develop a investment thought process to be able to accurately grow a brokerage account under any type of financial situations. If you find yourself like, well, you know, yeah, but if this wouldn't happen, if this politician didn't do XYZ, then we wouldn't have to worry about it or something, you might be right. I don't know. I personally, I don't really like politics. I try to pay attention to them as little as possible, just enough to sort of make sure that I'm trying to pay enough attention to be able to trade and invest properly. But as far as like who's right and who's wrong and this person's at fault and this, that, and the other thing, I feel like that goes against, you know, I talked in the other video, I talked about Jack Canfield's book, The Success Principles. Chapter 1 is all about you have to take full responsibility. And I think doing that is a form of not taking responsibility. Well, this president this, and if it wasn't for that president and this and that politician and blah, blah, blah. What's so funny about it is oftentimes people can be right, but they can still lose money. So it's like, what are you being right about? Are you being right about something that's going to make you money? Or are you being right about something that, like, even if you're right about it, you're still on food stamps? If you want to be on food stamps, like, go for it. But if you don't want to be on food stamps, or, you know, like a lot of people want to be these globe-trotting, traveling everywhere, Instagram celebrities. And if you're trying to do that through trading, then maybe it's wise. Maybe it's part of the skill of being a trader and investor to, at least when you're doing your trading and investing stuff, to step outside of this polarized, opinionated person and step inside to as much as possible, a Mr. Spock or Mrs. Spock, or whatever pronoun Spock you want to be, to step into this just logical. You know, Andy Tanner talks about this a lot, that you got, what's his name? Captain Jim, you know, who's all like, all glory, and he's just going to jump in, and no matter what, he's going to go for it. And then there's that Dr. McCoy who's always worried, you know, he's constantly fearing. But Mr. Spock, he's no emotion, just the facts. That's not that. I don't think that comes easy to most humans. I think most humans, we find it easier to be emotional and have this polarization and things like this. And I can tell from my own experience, you know, however your family is, it's really kind of makes it easier for you to be that way. And so you might have to develop that. As I mentioned, I'm gonna put in the description of this video, I'll put in a link to that New Harbor presentation, and hopefully you'll get a better idea of a bigger market, the debt market, that has a large impact on what the stock market's going to do. I'm also going to put in a link to the Manarino market, Manarino Market Risk Indicator, MMRI. Now, Greg Manarino developed this, I don't know, maybe a couple years ago, maybe 5 years ago. I'm not sure how long ago, but I've been watching it since it came out, and it's pretty accurate. It is pretty spot on. I don't particularly listen to Greg Manarino much, because to me he falls on that side of being really emotionally charged. and but nonetheless, the indicator seems to be very accurate. It's something like it's looking at the DXY, which is a basket of currencies compared to the US dollar, which is good to pay attention to, because if you listen to different financial podcasts and stuff, especially in the macroeconomic world, you're going to hear a lot of people referencing the Dixie or the DXY. So it's good to at least know what it is and have an idea, and to realize that it's, you know, it's looking at the dollar compared to these other currencies. So there's that component of the MMRI. And then there's a component, I think, of the 10-year treasury. So with this link, and then it's for some reason divided by like 1.61 or something. And then there's these different levels of it, like maybe 200 to 300 is like medium risk, and 300 over is like high risk. But the link that I'll put in the description here for you is going to be to a website that just shows you the MMRI. You can read about it a little bit. It has this nice, like, I don't know, like the car speedometer type of thing, where it shows you what the MMR is. A little bit lower on that has got a bit of a graph of it, so you can watch it, and it will show you like what's the DXY at, what's the 10-year yield at. And those are good things to pay attention to. And even though I can't quite explain it very eloquently, to try to get familiar with, like, if the debt market is tanking, I guess, kind of meaning like if people, big institutions, other central banks other than the Fed, if they aren't buying treasuries, or they're selling treasuries, or just not buying them, then generally the treasury yields need to go up. And if the treasury yields are going up, then it makes it more enticing for big amounts of money to move into these treasury yields to get like this quote unquote risk-free rate. Now, as that happens, as it gets more lucrative or enticing to invest in treasuries, then sometimes what happens is people that manage big amounts of money, or companies that manage big amounts of money, whatever, entities, institutions, hedge funds, family offices, mutual funds, endowments, all these type of things, wherever that big money is, then a lot of times those organizations will start putting money into treasuries, because, you know, why take as much risk on risk assets when you can get the quote unquote risk-free rate. And the other thing to, I think, kind of be aware of, that just throw into this conversation here with my buddy that missing a amputee here. Sorry about that, my friend. Is if that happens, if for some reason in the future there was a situation where I think the kind of joke is they threw a treasury auction and no one showed up, and the government had to really shoot up rates, what would happen in a scenario that rates were really going high, causing money to flow over there and money not to flow into the stock market? What would happen? The other thing to attempt to build into your framework is modern monetary theory way of looking at things, MMT. And I don't mean strictly like listen to the Warren Mosler interviews, especially when someone asks him a question and his only answer is, did you read my paper? Like, if you want to listen to that, if you like that sort of stuff, go for it. But when I listened to Stephanie Kelton interviews before, I was just kind of like, ugh. But I started getting more open to trying to understand MMT because from Kevin Muir, the macro tourist, when he started talking about, like, when he started trying to understand MMT, that one thing that he was saying is that it's a really good description of the way things run. I'm not sure if you can see that squirrel. Oh, it took off right on that tree. A really good description of the way things run, or the way things work. So because Kevin was kind of opened me to it, that's when I really started trying to re-listen to MMT people and start listening to more Warren Mosler interviews. But again, there's something just kind of rubs me a little bit wrong with seemingly, like, I don't know, like, watch it and let me know what you think I think adverb is for his personality. I think arrogant might be in there. Almost like you gotta kiss his butt or he's not gonna, did you read my whatever. So I was a little more open to it, and then I kind of stumbled upon this guy, Mike Norman. I think you can find him on YouTube with like Mike Norman, MMT Economics or Economic MMT. And what he talks about is specifically the stock market. What I'm hearing of his videos, that's all I pretty much hear him talking about, besides just some of the stuff that he likes to do. And I was really kind of intrigued when I listened to one, and the first one I listened to, he was talking about, I just got back from boxing. And the guy's older. He's like, you could tell, like, I know I'm middle-aged, and he's older than me. And so I was like, man, that's pretty legit. This guy's coming back from boxing class. Like, oh, MMT guy into boxing. And that kind of made me more receptive to listening to him, because even though I'm definitely not, wouldn't consider myself as a good boxer, like, I like boxing. I took boxing lessons. I wasn't very good at it, but I took boxing lessons. I sparred people. I like that. I got a punching bag, heavy bag. I like to hit it. So I was a little more open to that. So I listening to him more, and just find somebody, whether it's Mike Norman, maybe you like Warren Mosler, maybe you like Stephanie Kelton, maybe you like any of these MMT people, but find these different frameworks. And I think to try to have my own bitter medicine or whatever is, it's like listening to people. I mean, maybe not just anyone, like, maybe you need to be selective on the people you're going to learn from. Not maybe. I think you should be. But in a way, it's wise to seek out contrary opinions, not to prove them wrong. In the investing world, not to prove them wrong, but to look at something like, why is it that they have this opinion? What is their opinion? What's their stance? Why is it they have it? Is there something in their viewpoint that can allow me to see things differently, like the risk profile? Looking at a risk graph. If the stock moves down 10%, do I have enough buying power to still maintain the position? If you're able to develop this ability to listen to people that you wouldn't necessarily agree with, you wouldn't hang out with, you don't necessarily agree with them, and you're able to, like, with the type of Vulcan, Mr. Spock, Mrs. Spock type of way of just listening to it neutrally, logically, looking for something that you might have missed, because it's allegedly, Mark Twain said something like, it's not what you don't know that hurts you, it's what you know for certain that just ain't so. Now, whoever said it, I think it's pretty wise. A lot of times, I think the things that get us, and I know it's gotten me before, it wasn't that I didn't know something, it's that I thought I knew something, and that thing I thought I knew wasn't true. So if you're able to develop this ability to listen to people that have contrary opinions to you on things, and again, I'm referring specifically to trading and investing, but maybe you want to apply that to all of life, I don't know, it's up to you. But if you're able to do that, you might see things that you didn't see before. Maybe it's just a different angle. Maybe you're right, but maybe it's not about being right for some particular thing. Maybe it's about putting in a little bit of wiggle room. You know, for example, macro, micro. In the micro, we can understand this. Like, there were times when I lost money on crude oil futures trades, not because I was wrong, because I didn't have enough margin to maintain the position long enough for my right thesis to play out. That's really it. So in society, in this bigger picture, which the macro, what's going on in the politics, it 100% affects what's going on in the stock market. Look at the returns of a lot of politicians. Obviously, what's going on in politics really affects what's going on in the stock market. Hence, they make a lot of the politicians are illegally, or maybe they change the laws, so now they're legally making a lot of money with insider trading information. So obviously, what's going on in politics affects there. So how do you develop some sort of framework that's going to allow you to be profitable in the stock market without being stuck in the dogmatic nature of whatever political party you reside in? Because like the gentleman said, it's not one country, it's two political parties. Or at least maybe that's true. I hope someone out there in YouTube land can get some value from this, and I'm not just feeding the mosquitoes. I already got politicians parasiting off me as it is. You know, at least the mosquitoes, I'm out here giving it to them myself. So hopefully you got some sort of or can get some sort of value with this. And I think I'm gonna put all these different videos like this into a playlist of something like thought processes type of stuff. Now the futures market is going to be opening. It's probably already open. Last time I checked, I didn't see it moving. So I'm going to check that and work on uploading this, and need to review what positions I have open coming into this week, and look at what positions I might want to open up for the rest of the week. You guys have a great day. Aloha.